Hey, welcome everybody. Welcome to day 2 of Tax Conference 2021. I want to go over a few things with you today. Today was partnerships. That's not going to be much. We'll cover a lot because it's not really applicable for most of you. And then we'll also go over some initial individual stuff. And then we're going to be real heavy into individual again tomorrow too. So stay in, pay attention to all this. Hopefully you find it useful. I think there's some good nuggets and here we go. All right, so as I said, they started off talking about partnerships this morning, and really not a lot here that I want to go over other than really partnerships are a lot more flexible than an S-corp, but generally for most of my client base, you guys that are watching this video, the S-corp is still the better choice, unless you're investing in real estate or other things like that. So. And not always S-corp, sometimes single member LLC makes more sense, or C-corp. But for really the majority of our clients are S-corps when they get to a certain level. So I don't want to spend a lot of time on partnerships. I do want to say though, S-corp or partnership, and this was brought out a little bit today, and I 100% agree, use an attorney. So often we want to try to save a couple bucks and hey, I'm the king of cheap, but use an attorney to set this stuff up because it's not just registering with the state. You got to make sure you have a proper operating agreement or articles of incorporation. You want to make sure you have proper buy-sells in there. There's just a lot of little things that you may not think about, but if you ever need the protection of your entity, you wish you would have spent a few dollars with an attorney, and if you need one, I can help you out with that too. I've got several that I work with that are great, but it's really not worth saving a couple bucks up front when you're setting up your entity. So I think that was a good point, and I wanted to share that. I brought out the percentages. 50% of all partnerships are in real estate, and that makes sense. Most of our partnerships are real estate because it really does work well in that realm. Of those, 67% of those partnerships are established as LLCs, and LLC is the most common entity right now, and that's just because it's so flexible. That's why when you come to see me, that generally is the way we're going to go, because we can go through most phases of your business and not have to re-register and do all that. It really is a great way to go. Talked about some family limited partnerships, partnership basis, stuff that you guys really aren't going to be too worried about. Guaranteed payments. Now that was a good one. Those who have a partnership get quite often something called a guaranteed payment. And that's a lot like a payroll or a wage in a corporation. And the thing is when you get a guaranteed payment, it reduces the qualified business income deduction that you can take, which is that QBI deduction, or a lot of you just think of it as a 20% deduction that we've had the last several years. Your guaranteed payment is it reduces the amount of QBI. So for most of you, if you have guaranteed payments, we really need to think about if there's not a better way to get payments to you so that we're not giving up the QBI on those payments. And there's probably, like I said, there's probably a better way. So I did want to bring that out. If that's any of you with partnerships that are taking a guaranteed payment, maybe it would be really wise to reconsider how you're getting paid. And that's really all I want to talk about on partnerships. It's pretty technical, not stuff you guys want to listen to. So we'll skip that. That was 4 hours and a couple minutes, and we'll move into individual. The first thing that we discussed was donor advised funds, and I think they're great. I talked about this last year, and the way it works is because the standard deduction is so high nowadays, a lot of people don't have enough to deduct on their itemized deduction. So what you can do is bunch things up. So year one, donate $20,000, $30,000, $100,000, whatever it is you want to do, into a donor advised fund so that you have enough to actually take advantage of the itemized deductions. Then in year 2 and 3, or whatever our system is we take the standard deduction and then we do a donation to the donor advised fund in the right year. And we got to work all this out, and everybody's different. But what happens is you get the deduction that year, And then over the next 2 to 3 years, you can dole that money out to the charities you want. And so it's a win-win. You get a deduction, you get to support what you believe in, and then in the other years, you get the benefit of the high standard deduction. So it's a great plan. I like it. They work really well. Fidelity has one that's very inexpensive. Your financial advisor, they have probably, at least most of them have access to some of those, and they're a great deal. And on that same topic, they didn't bring it up today, but there's also the concept if you're getting your required minimum distributions on your IRAs, we can also divert those to charities. And we talked about that last year too. So I want to make sure you guys understand that that's called a qualified charitable distribution, and that may come up tomorrow, but just want to make sure we cover that while we're here. Okay, while we're also talking about charities, not a big deal, but they raised the front page from $300 to $600, so we can deduct $600 on the front page of charities. Not a big deal, but every little bit helps, and that's our goal. Meals. Talked about meals today, and meals for 2021 are 100%. I know we brought that up before, but you may not have remembered it. So they're 100% deductible for this year, whereas normally they're only 50%. So the point I want to bring out on that is, one, I want you to remember that, but two, what did come up today is there's a court case that recently came down, and even though they had all the receipts, the court tossed it because they did not have it documented who and why they were having the meal. And we've talked about this before, but with this court case that just came down, it's only going to strengthen the IRS. It's just like mileage, you got to document. You need to flip that receipt over and write down, I had lunch with Doug Burson, my accountant, taxes. Something so that when they audit you, if they do, you can back it up. And everything is documentation nowadays. So I want to make sure it's not that hard. Just flip it over, write it down, and put it in your folder, and then you've got it and you're covered. Now, over the last couple years, there's been a couple questions on the tax return. And we always ask, and we try to reach out, but this year it's going to be even more important. One is the foreign bank account. Do you have foreign bank accounts? That's a big one, and the IRS is really coming after that. And then there's also the cryptocurrency. And in the past, the crypto wasn't as big of a deal, but this last year, a whole lot of you have invested in cryptos, and we have no way to know on our end. So I'm not going to be able to finish the tax returns this year unless you let me know yes or no on crypto and yes or no on foreign bank account. And we're going to send out a questionnaire at the end of the year. But it's really, really important. I'll probably send it out mid-January. Really, really important. You go through and you check those boxes. I know it's annoying, but we got to do it because otherwise your return is going to get delayed, because until I get those answers, I'm not going to be able to finish it. And on that same vein, let's talk a little bit about the child tax credit. We may do another video on the child tax credit and the stimulus payments to get into details. The only thing I want to cover today is they're going to send out letters at the end of the year that say how much you got. I need those letters. Don't throw them away. We're going to need them, Cindy and I, when we're doing your tax returns, to verify you got what we think you did. Because without that, the return's going to be delayed. I got to verify it because the IRS is sending out notices like crazy on these things for last year. We have to have it. And they're going to give it to us this year. It's going to be easier, but I want you to know they're coming so you don't not realize what it is and toss it away. So look for those. There's going to be one for the stimulus payment, and there's going to be one for the child tax credit. And while we're talking about the child tax credit, that one's going to be tricky this year because a lot of us have gotten the advanced child tax credit. We have. I'm going to have that number, but what's even trickier is some of you may switch off who gets to claim the child each year. And when you do that, you may have got the advanced stimulus or the advanced child tax credit, but maybe it's not your year to claim the kid. And so these are some of the tricks that we're going to have this year to keep up with. So it's going to be critical that you let us know so that we make sure that if you didn't get the credit, we can do it. And make sure it all balances out. And it's also going to be very important that you talk with the parent of the child if you're not still married or together, to make sure that everybody understands, because when we claim the tax return and claim that child on your return, if the other parent already got the advance credit, we're going to need to know that, because I'm afraid if we file the return and you say I haven't gotten anything, we're going to file the return, it's going to get delayed, then they're going to adjust your refund and it's going to be a mess. So it's very, very important that we communicate and work together on this. You're going to have to work together. We'll try to work together. But it's going to be a complicated season this year because of some of those things. And I just want to give you a little bit of forewarning. There have been some major changes to earned income credit. A lot of people who weren't eligible will be eligible. They've removed the age restrictions as far as how old you can be. They've also moved it down, I think, from 25 to, I think it's 19. I'd have to look that up. Like I told you guys yesterday, it's tax conference, a lot of information. I don't have time to verify it all. I just want to make you aware of things as I'm seeing them. So, but the big deal is a lot more people are going to qualify for that. We may do a separate video on that, I'm not sure. Year's drawing in close on us, but there may be some benefits to you on that. Also, dependent care benefits. Historically, it was like, I think, $3,000, and they've doubled that. So the dependent care benefit, think daycare, has had a significant upgrade. So make sure that you get me the information on your daycare, because the credit is much larger this year, and you're going to see some of you who may not have been eligible before will be, or you'll be eligible for more. And in some cases considerably more. So when I call you and bug you about, hey, why don't I have the daycare? It's important, get it to me early. Once again, it'll keep your return from being delayed, and it could be worth quite a bit of money on your tax return. And then this thing came up, which I really didn't like, but they don't ask my opinion. 1099K, most of you don't know what that is, but when you get paid by somebody through a credit card, they're required to give you a 1099K if your income was, I believe it was $20,000 in revenue. And so for most people who sold a few things on eBay, Amazon, Etsy, it really wasn't a big deal. And sometimes you weren't even making profit, it's more of a hobby. I sold a few things, may not even made any money, no big deal. Well, now starting next year, if you get, I believe it was, $600. If you get $600 in payments for services or product on any of these platforms, you're now going to get a 1099K. And what that means in reality is the IRS is going to know you've been selling on Etsy, eBay, whatever the platform, and now they're going to be looking for a tax return that reflects that income. So why am I telling you this? One, things just changed. Those few sales you thought weren't a big deal, it is now. And you're gonna wanna make sure that you start treating what might have just been a hobby more like a business. You're gonna wanna keep records, because you're not gonna wanna pay taxes on the whole thing. You're gonna be able to deduct the expenses. In order to do that, we're gonna have to treat it like a business. So that's not this tax return, but it is the next one, and I want you to know that's coming so that you don't get surprised, and starting with the first of the year, if that's you, you can take action to make sure you're protected. Okay, this one's big for a lot of you guys who are self-employed with the Schedule C. Think single member LLC, disregarded entity, or just a standard sole proprietor. There was a lot of stuff that went on with the employee retention credit for businesses with employees, but some of you don't have employees, or even if you did, that part's not relevant. But on a Schedule C, if you were impacted by COVID, in other words, you were sick with COVID, you were quarantined because of COVID, your spouse got COVID and you had to stay home and weren't able to work, of these kind of things. Make sure you let us know for the tax return this year, because there's two different credits. There's the paid, it's the paid sick credit, I think it was, and then the Family Leave Act. One has to do with your children. For instance, the school was closed and you had to stay home and you weren't able to perform your duties. Not somebody who could telework and keep getting paid, but somebody who actually wasn't able to work anymore. Or you got sick, maybe you got COVID and weren't able to work for 2 weeks. The credit's pretty substantial. I need to know it. And if we didn't catch that last year, maybe you didn't think about that, let us know, because maybe we need to amend last year's return potentially to get you the rest of that credit. It could be worth up to, I think it's like $5,000, up to $500 a day for 10 days on the one. And then the other one is $200 a day for, I don't have it in front of me, like I said, this is kind of going off the cuff, but they can be big credits. So if that was you, make a note for us for the tax file this year, and we can get into the details of it on a one-on-one basis. And I think that kind of covers enough for today. There was a lot more, but I want to wear you guys out, try to just hit the highlights. Tomorrow will be a lot more individual stuff. Like I said, I'm trying to condense 8 hours into a short video for you. If there's anything in here that wasn't clear, drop a note down below. Let me know if there's specific questions. Got a lot of other great accountants down here with me. Maybe I can run it by some of them if you got a unique situation. I hope this has been beneficial. I'm not sure what I was getting into saying I would do this at a conference, but I'm glad to help you guys, and that's what we're here for. We want to help you be successful too. So that's it. Have a wonderful, well, for me it's nighttime now, so you guys have a wonderful night, and we'll talk again soon.